What makes us the go-to auditor for public companies is we take a client-centric approach.
We perform a variety of audit-related services.
Of course, we do public company audits, interim reviews, initial public offerings, secondary offerings, and we do internal controls audits as well.
We perform audits across many different industries. Some of them are renewable energy and mining, crypto, cannabis, technology, and manufacturing.
Being a part of Nexia allows us to have global reach, having affiliates in almost every country in the world.
Being a member of Nexia allows us to tap into local expertise and deliver cost-effective audits and bring value to our clients.
We are experts in acquisition transactions as well as all financings for companies going public.
So at the firm here, we're agnostic to the industry. We're market driven. When the market chooses a new industry, we build up our expertise to learn how to do it.
Having the same audit team allows both us as auditors and our clients to realize efficiencies, utilizing accumulated knowledge year over year, so that we can help you anticipate and solve your problems.
What sets us apart is our audit team is always available. You can pick up the phone and get a hold of us.
But I would say the biggest one is the people. Our name in the market and even internally, we are the people as you see. We are represented well by our personalities and our agility. I think that's why people come to us.
In the context of audit engagements, our agility ensures that we swiftly adapt to the evolving needs of our clients. Our service exemplifies integrity by consistently delivering honest and transparent solutions.
Good afternoon, everybody. Welcome to our annual 2024 Public Company Update. My name is Erez. I manage Davidson along with my partners and our staff. And we'd like to welcome you here today to give you an update about what's going on in public companies, updates about accounting as well. We're here at the Art Gallery in downtown Vancouver. It's a beautiful fall day today. And there's some people here live, and a lot of you will see this broadcast online, I think in about a week from now. So I'll go through a couple housekeeping things first, let you know about what's coming in these next couple hours, and just a quick update about our firm as well. So for those of you who are here in person, please help yourself with some coffee over there. You don't have to wait until the very end. If we could ask one favor, to turn off your cell phones, because it's a bit of an older building and a lot of the sound travels easily. I did that before. If you could put it on silent, if you check your phone during the thing, that's okay. But if you don't mind. And then for those of you who want to use a washroom, the ladies' washrooms are just down the hall here on the 3rd floor. For men, you have to go one flight of stairs up on the 4th floor. We should be scheduled to end promptly at 4 p.m. today. So we'll have a bit of a networking social item between 4 to 5. And at the Art Gallery, they like us to leave exactly by 5 p.m. So it'll be over by then. So if you're having a glass of wine, try to grab your last one by about 4:45 p.m. or so. A couple other things about that's going on in the firm. I think hopefully many of you by now know that we're celebrating our 40th anniversary at Davidson. We've been around since 1984, and we're doing a big bash this year on November 27th at our offices. It's going to have a bit of an 80s theme. You probably can't see this, but we have these cards. A few of them are at the front with a little Back to the Future, one of my favorite movies. So come dressed up in 80s gear, or for some of you in the audience here, you just have to brush up your clothes from when you were a teenager or in your 20s and so forth. And for those of you who weren't even born in the 80s, and there's a couple of you here, it was quite a decade. On January 17th as well, upcoming events in 2025, we'll have our annual regulatory and TSX Venture update as well, so come look for that. And just, check your inbox. If for some reason you're not on our mailing list and want to be invited, including to events, please do email us or just contact our firm. We keep in touch with lots of people, so we just want to make sure that we have your updated address, email, etc. We try to get it as right as we can, but every once in a while we do miss it. A couple updates about Davidson and Company. We've had a lot of changes in the last years. We continue to do this as part of our community outreach program. But our firm has increased its infrastructure in the last couple of years, particularly after COVID. You know, we brought in a lot of support for IT, HR, our marketing. We've hired people, we've increased our capacity, and we're very thankful for the community that have kept on supporting our firm over the years. And what we want everybody to know is that Davidson & Company is here to stay, and we are open for business. And we're looking to grow and expand and continually serve all size companies, small or larger. It's very important for us to stay in the community, to support the venture market, as well as growing companies. Today, we're going to give you a public company update. We also have a special guest here to my right, Anita Sear from the British Columbia Securities Commission, who has been with us doing this for a couple years now. So we're really thankful for Anita to come here and give us an update from the British Columbia Securities Commission. And then you're also going to hear from six of our senior people here, partners and principals, about what's going on at IFRS, what's new and exciting that's out there. And we'll do a bit of an industry spotlight for a junior resource company. We do believe that there's a bit of a turnaround in the mining sector. We're starting to see a few new deals coming up. A few companies are reactivating some companies that have been sort of dormant for a couple of years. And we've been saying it for a little, and then also what's new in the regulatory landscape too. And we've been saying it for a little while now that, you know, our firm's belief is that COVID was COVID, and now we're kind of going through the last bits of that. The interest rates are starting to come off, and the debt markets are loosening up. And we firmly believe that there's going to be a real period of growth in the roaring 20s. Where history repeats itself. So we're quite optimistic, not necessarily about the balance of 2024. The markets have been tough, maybe the first part of 2025 as well, but we believe that the latter part of this decade will be a good one for all. That's sort of the housekeeping items. We'll have a Q&A session at the end too. So for those of you who are here, you've got cards in front of you. If you want to ask us anything, follow-up questions, please feel to do so, and maybe hand it over in the back. The session is expected to go about an hour and a half or so. I know we'll leave some time to the Q&A at the end. And then of course, if something that you want to know about doesn't get answered today, please feel free to reach out to any of our partners. They'll respond to you timely and available on our website if you need any of our contact information. So that kind of covers the housekeeping, and so without further ado, I'd like to introduce our first speaker, Anita from the BCSC, who's going to tell us what's going on. And for those of you who don't know Anita well, she's a football fan. Was it Seahawks? That's your favorite team?
Yeah.
Sometimes? How are they doing this year?
Yeah.
Okay, maybe. Okay, we won't talk about that one any
Also
further.
the Giants, so that's rough too.
Okay, all right. Well, that's to get to know a little bit about Anita. So may I invite you up here, Anita? Thanks.
All right, good afternoon, everyone, and thank you, Arez, and the rest of the Davidson team for inviting me out. So I'm the Chief Accountant at the BC Securities Commission. My office provides accounting and financial reporting expertise to all the divisions of the Securities Commission. We also participate in policy projects to update our rules and procedures, especially as they relate to accounting, assurance, or either financial reporting. So I'm really happy to be here because one of my favorite parts is to be able to talk to issuers and their advisors. So I'll have my contact information here on the end of the slide, so please feel free to reach out to me if any questions come up, or if you have any other questions about any other securities related matters. So I'm going to provide a regulatory update from a corporate finance perspective, and we're specifically focusing more on accounting and financial reporting issues that we've seen in our reviews over the past couple of years. I'll also touch upon a couple of IFRS amendments, and not so much the details, but just in terms of how they interact with your securities filings beyond the financial statements. And we'll look ahead at some of the CSA publications or publications from the Canadian Securities Administrators that you can look forward to into 2025 or so. So getting into the presentation then, here are the financial statement areas where we've commonly provided comments to issuers. I don't think any here would be too much of a surprise for those of you in the room. I would note that the middle three, impairment, transactions, and intangibles, tend to be connected. But first, let's talk about the first one, and comments were raising relating to how issuers are considering the general economic conditions. It feels like we've had a variation of this comment in each of the last 4 to 5 years, ever since kind of the black swan event of the COVID pandemic first started. In times of economic and geopolitical uncertainty, though, it is challenging for issuers preparing their financial statements, as there could be material changes to the entity's operations and the business environment over a short period of time. And external events such as natural disasters or geopolitical unrest, inflationary pressures, these may cause economic conditions to deteriorate and exacerbate existing economic uncertainty for many companies. So management needs to carefully consider and evaluate how these events affect various aspects of the financial statements. This includes your disclosures, impairment of assets, or whether the events or conditions result in material uncertainty that casts significant doubt upon the entity's ability to continue as a going concern. And sometimes the conclusion that there is no material uncertainty is itself a significant judgment requiring disclosure. Disclosure of areas where management has made judgments is often an area that staff will focus on in their reviews, especially during times of general economic uncertainty. As example, while interest rates are starting to come down, the impact is not being immediately felt. So investors may wonder how an entity's financial statements and future prospects are affected. And disruptions to supply chain and global trade continues due to conflicts and climate events. I read somewhere that there are more than 70 countries that are undergoing elections this year. So this uncertainty creates significant challenges in management applying judgments when making assumptions about the estimated cash flows to support, for example, impairment testing and going concern assessments. And the cornerstone of our regulatory regime is disclosure, and our approach in reviewing disclosure is based on the principle that investors need sufficient and appropriate information in order to make an informed investment decision. So often this means that disclosures about the judgments management has made and in their assumptions relating to useful life of assets, for example, discount rates, projections of future cash flows, are important areas to allow investors to assess the reasonableness of those assumptions. Other areas where assumptions are affected by the economic uncertainty include entities' consideration of expected credit loss and their ability to meet debt covenants in this uncertain times. These can all have significant effect on the financial statement amount, so is an area of focus by our staff. And just briefly on events after the reporting date, external events can evolve rapidly and impact how companies evaluate and disclose subsequent events. And judgment needs to be applied in considering whether events are adjusting events that need to be reflected in the measurement in the financial reporting period, or are non-adjusting events which still may be material, in which case its disclosure about the nature and the estimated financial effect might still be required. So another area I want to spend some time on is around transactions, and this is both transactions that meet the definition of a business combination under the accounting standards, as well as asset acquisitions. Some trends that we've observed, especially given the importance of the venture market in BC and the tendency towards early growth stage companies, include where a significant portion of the significant amount of equity is included as part of the consideration and the exchange amount. And oftentimes the fair value of the consideration is significantly more than the tangible assets acquired. So this results in a significant balance of either goodwill or intangible assets. Where this is the case, we've often raised comments about the sufficiency of disclosure to explain what was exactly acquired and the basis for recognition. For example, if goodwill was acquired, IFRS 3 has very specific disclosure requirements about the qualitative factors that make up goodwill. For intangibles, IAS 38 similarly has specific disclosure requirements relating to the class of intangible assets acquired, whether the useful life is finite or indefinite, and if it is an indefinite-lived intangible asset, then reasons that support management's assessment is also required for disclosure. We've also asked questions about the valuation of the consideration transferred, especially in share-based transactions where the shares are thinly traded, or if there is a non-arm's length relationship between the two parties. Even where there is no related party transaction, as defined under IS 24, we've also raised questions about how fair value was determined and whether the exchange amount is indicative of fair value. Another observation we're seeing is where impairments are taken in the same financial period in which a transaction has taken place, perhaps in a later interim period. And when we see impairments taken shortly after a transaction closes, we often have questions about whether there was sufficient disclosure about the transaction and management's rationale for that transaction in the first place. So this brings us to some specific comments we've raised about intangible assets acquired. We're going a little bit back to basics here and may ask questions about whether the criteria for recognition have been met. This includes criteria for identifiability, for example. And in order for an intangible asset to be identifiable, it must be separable and capable of being divided and sold. And it has to arise from contractual or legal rights. In addition to identifiability, the issuer must also have control over the intangible asset, and there must be probable future economic benefits to support the fair value of intangibles acquired. So we expect management to assess the probability using reasonable and supportable assumptions. Where there is a significant amount of intangible assets recognized in the financial statements and where there's insufficient disclosure about the assumptions used to support the carrying amount, we've also raised questions about whether the intangible assets are impaired, and specifically we could ask questions about the assumptions that management have made to come to their conclusion. And in addition to impairment testing with intangible assets specifically, impairment more generally, whether that's of other assets or CGUs, is also a common deficiency that we've noted in financial statements. An issuer is required to assess at the end of each reporting period whether there is any indication of impairment, and if such indication exists, then the issuer is required to estimate the recoverable amount of the asset. So both internal and external indicators need to be considered. And we've observed that in considering whether there's been an impairment, again, whether that's to an asset or a CGU, a cash generating unit, some issuers use boilerplate disclosure or don't sufficiently disclose the basis for the key assumptions used by management in determining the carrying amount, recoverable amount, whether that's value in use or fair value less cost to sell. And in some cases, there's insufficient disclosure about the CGU itself. There needs to be sufficient disclosure to enable a reader to understand the specific group of assets impacted by an impairment or an impairment reversal. We also want to remind issuers that we expect there to be sufficient explanation of the specific factors, events, or circumstances that led to an impairment. General just reference to impairment indicators may result in us asking for more specifics. And irrespective of whether there is an indication of impairment, for certain assets, an annual assessment is required. So this is for intangible assets with indefinite useful lives, intangible assets that are not yet ready for use, or goodwill that's acquired in a business combination. Some other areas where staff at the commissions have raised comments include fair value, expected credit losses relating to financial assets, and revenue disaggregation. And I'm repeating myself here a bit, but you'll see a common theme amongst all these areas is whether there's sufficient disclosure about the significant judgments management has made about the inputs and assumptions and methods used to determine the amount that's been recognized in the financial statements. This is true, of course, for fair value and expected credit losses, as well as some of the other areas I've spoken to already. On revenue disaggregation, we've noted that there are issuers who do not always provide the disaggregated revenue by categories that would allow investors to understand how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by different economic factors, and to allow investors to evaluate an issuer's financial performance. Issuers need to consider the connectivity of disclosure outside the financial statements with that in the financial statements. For example, how do you discuss your operations in your MD&A, in news releases or investor presentations? This may mean that an entity may need different categories to ensure there is sufficient disclosure. So maybe that's by geography and product type, as well as by sales channel or the timing of recognition, whether it's at a point in time or over the life of the contract. So those are some of the prevalent accounting issues that we've noted, and I also want to touch on a select few other areas. Maybe I'll do a plug for the January session, the Res plug, because I'll have some colleagues that will be presenting there at the regulatory and TSXV update. But I do want to give us some high-level thoughts on areas outside of the accounting at this point as well. We've commonly raised questions, and one area is on problematic promotional disclosure. And when issuers provide disclosure that's unbalanced or untrue, this is what we mean by problematically promotional disclosure, especially when the disclosure is part of a promotional campaign that provides claims about the issuer's business or the corresponding opportunities for profit resulting from investments in the issuer's securities. A couple of specific examples of problematic promotional disclosure we've observed recently include greenwashing and AI washing. You're likely very familiar with the term greenwashing. This has come up in our CSA publications in the past couple of years, but it continues to be relevant as investor interest in ESG or sustainability and climate-related matters continue to be high. And greenwashing can be any misleading, unsubstantiated, or otherwise incomplete claims about the business's operations or the sustainability of a product or service being offered and conveys a false impression about the entity's environmental impact. So while the CSA continues to consider our approach to mandatory climate-related disclosure requirements, issuers who already provide this disclosure, whether voluntarily as part of a sustainability report or whether they're required to do so in their AIF and MD&A because climate-related risks are already material to the issuer, I've included some reminders here on the slide to how an entity might ensure that disclosure isn't misleading. They shouldn't be new to many issuers in the room. You'll notice that they tend to be consistent with our approach to when issuers disclose forward-looking information, for example. I will highlight that one way entities can avoid greenwashing is avoid overly broad or confusing terminology. For example, a general statement about a business being ESG friendly or green or compliant with industry standards can be misleading without accompanying disclosure identifying the specific industry standards and the criteria used in that standard. So again, avoid boilerplate disclosure and focus on the specific criteria. AI washing is a newer term, but similar to greenwashing, it is when disclosure includes false, unsubstantiated, or exaggerated claims about an entity's use of AI systems, either in their products or services or in how they run their business. AI washing has become prevalent as investor interest and demand in AI systems grows. And again, no surprise, BC has a very strong venture market and many early stage businesses who tend to be at the forefront of new industries and trends. This was the case, for example, with cannabis issuers as companies try to take advantage of changing regulations and laws in this area. And we're seeing similar trends as companies try to take advantage of the growing use and interest of AI. Issuers who are exploring AI products or services or purport to have AI systems in place as a competitive advantage should ensure that any disclosures made about their use or adoption are factual and balanced. For example, fulsome disclosure of the opportunities available to an entity can assist an investor in understanding the company's AI systems, but would be imbalanced if there's not also accompanying disclosure of the risks associated with AI use, for example, related to privacy or confidentiality or bias in the training data. Another example of exaggerated claims that veers towards AI washing is when an issuer's continuous disclosure record, for example, the MD&A or news releases, focus entirely on new AI technology and the company's expected growth due to projections in this business segment. But upon further review, when we look at the financial statements, which are required to comply with IFRS accounting standards, all of the company's revenues came from, let's say, traditional widgets, so not AI related at all. So without a fulsome discussion of the entirety of a company's operations and segments, such disclosure could be misleading. So a reminder that disclosure is, of course, interconnected in and outside the financial statements. This link to our website provides more information for companies and promotional communications and is a good resource for management when sharing information about a company to potential investors. Included on that website link is the next area I want to chat briefly about, which is non-GAAP financial measures. Non-GAAP financial information does not comply with an issuer's GAAP, and so could be misleading as there's no standardized calculation of measures, and each entity can choose to disclose their non-GAAPs differently. We do have securities law requirements for an issuer to provide certain accompanying disclosures to ensure that disclosure is balanced, consistent, and comparable. But it has historically been an area of problematic disclosure as it's an entity cherry picking how they want to convey their financial performance. So for those who want to tell their story in their own words, you're welcome to, but you just have to ensure that there's enough context so that the disclosure isn't misleading. Very quickly, I did want to mention that while staff in our corporate disclosure group focus on reviews of issuers' continuous disclosure record, we also do review when an entity relies on prospectus exemptions to raise capital, at least at a high level, to ensure that the criteria are being met. And we'll scan various documents such as offering statements or reports of exempt distribution. For example, an issuer that's using a listed issuer financing exemption is required to ensure that they have sufficient resources for 12 months of operations. So an analyst might look at the financial statements to ensure there's sufficient working capital. And where it doesn't appear that the criteria is met, we may do a more in-depth review at that time. So more regulatory intervention, but only if warranted in this area. On to a slightly different topic now. I did want to chat about a couple of IFRS amendments where we need to consider how they interact with securities law requirements beyond the financial statements. So this isn't going to be a PD session on the new standards. I think Catherine and Carmen might be stealing their thunder a bit, but I did want to mention that as a regulator, there are a couple of areas that we have to consider changes to either our policies or procedures, or where we may need to provide commentary, as there could be an overlap with the IFRS requirements and securities law requirements. The first standard, IFRS 18, presentation disclosure in the financial statements, will be replacing IAS 1. This is not going to be the first session in which you're going to hear about this standard over the next couple of years, and I anticipate there will be many more sessions as we get closer to the effective date. Again, it's not, I'm not here to do a crash course on IFRS 18, but I did want to alert you that based on conversations I've been hearing, so this is from the standard setters themselves as well as some of the PD sessions I've attended, issuers may need to devote more time to implementation than first meets the eye, because there really is a lot under the hood, and it's probably prudent to start sooner rather than later. There are broadly 3 areas of changes: new required subtotals in the statement of financial performance, required disclosure of management defined performance measures, or MPMs, which are a subset of what we know in Canada as non-GAAP financial measures, as well as enhanced guidance on aggregation and disaggregation. Many have noted that there might need to be systems changes in place as a result of new categories and new subtotals required in the income statement. And even if your presentation of the income statement might not change, I've heard there's expected to be a lot of documentation on the back end to support the fact that there might be no changes. But the key piece I want to draw your attention to relates to the interaction with securities law is on the management defined performance measures, MPMs. MPMs are subtotals of income and expenses that meet specific criteria outlined in IFRS 18. And prior to the introduction of MPMs, these were traditionally considered non-GAAP financial measures. For example, adjusted operating income, which historically have only been presented outside the financial statements and disclosure documents such as the MD&A, investor presentations, or news releases. So because of the overlap of IFRS 18 with securities law requirements in Canada, we're considering the implications to our rules and considering the amendments necessary to 52112, our non-GAAP rule. Disclosure of MPMs outside the financial statements without the accompanying disclosure that we currently require for non-GAAP financial measures may be misleading. So the CSA is working towards amendments to ensure that there continues to be accompanying disclosures to MPMs when these are presented outside the financial statements. For entities that want to early adopt IFRS 18, we encourage you to reach out to the securities regulator to discuss further. But generally, we expect issuers to continue to apply 52112 to those financial measures disclosed outside the financial statements that other than the fact that they are now identified as NPMs and disclosed in the financial statements of the entity, would have met the definition of a non-GAAP financial measure in our rule prior to the adoption of IFRS 18. Also, one quick item as we move closer to adoption of IFRS 18, the MD&A does require disclosure of the anticipated effects of standards and policies not yet adopted. As we get closer to the effective date, we do expect more detailed and quantitative disclosure. So I'm sure this is something you'll hear more about as we get closer to 2027 as well. The other IFRS standard I want to spend a little bit of time on is on 19, which is a disclosure standard which allows certain subsidiaries of public companies to, without public accountability, to provide reduced disclosures in IFRS financial statements. Entities with public accountability include those that have debt or equity instruments traded in the public market or in the process of doing so. Given this definition, we don't expect there to be a significant, we expect there to be limited use of IFRS 19 by our issuers, although there may be certain situations where a subsidiary could be eligible, such as in a business acquisition report filing, where the acquired business doesn't have public accountability. IFRS 19 still requires the subsidiary to consider whether additional disclosures are required for investors. This might be the case given that a bar filing is a securities filing and part of the record required for investors to make an informed investment decision. So if you think IFRS 19 applicability is uncertain or maybe unclear in your particular facts and circumstances, I encourage you to reach out to us in advance of any filing. And finally, a couple of climate-related areas of connectivity with the financial statements I want to mention. Earlier this year, the IFRS Interpretations Committee, and they issue authoritative guidance on the application of IFRS accounting standards. They issued a final decision on whether net zero or climate-related commitments result in a constructive obligation requiring recognition in the financial statements. The decision noted that whether a constructive obligation exists depends on the facts and circumstances, but in the fact pattern submitted, the IFRIC concluded that a company does not recognize a provision at the time it makes a statement about climate-related commitments 9 years into the future, as there's no present obligation as a result of a past event. So I encourage those of you who are affected, who have made or consider making net zero or climate-related commitments, to review the IFRIC agenda decision to ensure you've properly considered how climate-related disclosures relate to your financial statements. The IASB, the International Accounting Standards Board, also issued an exposure draft early this year with comment deadline November 28th, so there's still time for you to get your comments in. They propose illustrative examples of how entities consider climate-related and other uncertainties in applying certain IFRS standards. There are 8 proposed examples relating to materiality judgments, disclosures around assumptions, credit risk, restorative and decommissioning provisions, as well as disclosures about disaggregated information. Illustrative examples are not authoritative guidance, but they are further along the scale than guidance. So if this is an area of connectivity, so because it's a little bit further along that scale, there could be judgment in considering whether the examples are applicable to an entity's particular situation. So again, if this is an area that's of interest, I encourage you to review the exposure draft and consider issuing a comment letter to the IASB. It's important for them to get perspectives from different market participants. They do hear a lot from users, and preparers are also an important group for them to hear about some of the costs and benefits of any proposals. In terms of other IASB projects that the regulators are looking at, we're interested in the results of the IASB's research project on intangible assets, and we're also looking forward to seeing the final standard on rate-regulated activities. And finally, some upcoming publications from the CSA and the BCSC that you can look for. The next biannual publication of CD, Continuous Disclosure Review Outcomes, is anticipated to be published in early November, so look for that for more details of what I shared with you today. I've also listed a select number of corporate finance policy projects where there could be publications into 2025. The audit committee one is anticipated to be a consultation paper, but some of these are re-proposals or proposals or final amendments as well. So if any of these are of interest to you, please feel free to reach out to me or go to our website and subscribe to receive notifications of new publications. And with that, I'll leave my contact details here for those interested in reaching out. Thank you for your time, and I think I'm passing it to Carmen for the next session. Thank you.
Okay, great. Good afternoon, everyone. So my name's Carmen Nuno. I'm an audit partner at Davidson & Company, and the topic I'll be discussing is standard issued but not yet affected. So many of you are probably familiar with this topic. You generally see it in your after your material accounting standards note in the interim and audited financial statements. Generally, it's probably something you discuss with your auditor, or we kind of assist you, provide you with what's coming up, and then hold a discussion with management on how it may affect your company. So we will go through what the upcoming amendments are. This right here is an example of the current financial statement disclosure. Upcoming, we have 2 items: amendments to IS1, presentation of financial statements, as well as IFRS 18, presentation and disclosure in financial statements. The above disclosure just highlights the changes. So it's generally pretty consistent from financial statements to financial statements. However, as Anita mentioned, it is also a requirement for a company to put how this will affect them, or if they're still in the process of determining how that's going to affect them. However, I would say if that amendment is coming within the next year, the company should kind of have anticipated how it's going to affect you and be putting what the likely change they are expecting is, if any. So I will be walking through IAS 1, the easier one, let's say, and then I'll hand it off to Catherine, who will be doing the more anticipated IFRS 18. So in January 2020, the IASB amended IAS 1 presentation of financial statements to provide a more general approach to the presentation of liabilities as current or non-current, based on contractual arrangements. So how would this affect a company? Generally, they may see some changes on how you classify your liabilities between current and non-current. Looking at it in a little more detail, the amendments specify 3 bullet points. 1, specify the rights and conditions existing at the end of a reporting period are relevant in determining whether the company has the right to defer settlement of the liability by at least 12 months. Number 2, it gives guidance that management's expectations are not relevant. Therefore, if management says, we think we may settle it within the next 12 months, and that's why they're classifying as current, that is no longer relevant. It's basically based on the contractual terms of the arrangement. And lastly, it clarifies when a liability is considered settled. Based on the assessment, there will be a potential additional disclosure requirements as well. And this is where I kind of see the biggest change for most of our companies. This was supposed to be effective this year. However, in October 2022, the IASB amended it to be effective next year. The effect is also retrospective. Looking at the change in a bit more detail, the existing standard more defines what a current liability is. It states a current liability a liability is current if, among other things, the company does not have the unconditional right to defer settlement of the liability for at least 12 months after the reporting period. The amendment changes this as it defines when a liability can be classified as non-current. It says a liability can be classified as non-current when the company must have the right, and the right must be existing at the end of the reporting period to defer settlement of that liability for at least 12 months. The classification of the liability must be unaffected by the likelihood that the company will exercise that right. So next, the disclosure requirements. Additional disclosure must be added to users to understand the risk that the liability could become repayable within 12 months after the reporting date. Specifically, it requires disclosure details about the covenants themselves. So generally the conditions, the nature and the date by which the entity must comply with the condition, whether the entity would comply with the condition based on its current circumstances at the date of the reporting date, and whether and how the entity expects to comply with those conditions by the date on which they are required to contractually be tested. Some additional points to note is that the amendment does not change how the company should classify a liability if there is a breach. If there is a breach, the company should still classify the liability as current if that breach occurred during the current period, and if they have not received a waiver during that period. If the waiver is received subsequent to year end, at the end of the reporting period, it would still be classified as current. The second point is the amendment clarifies the treatment of a liability that has a conversion option. Generally, if there is a conversion option, a company will determine if that conversion option is classified as equity or liability. The standard states that if that conversion option is classified as an equity, the host liability is not associated with that equity instrument. However, if that conversion option is associated as a liability, then your host liability will also be classified as current or non-current in consistency with that. So that might become more clear with a couple examples. Reading this example here, company XYZ has a financial year end of December 31st. During the current year, the company entered into a loan facility due in December 2027 and is subject to annual covenants based on the entity's financial position at December 31st, 2024 and each subsequent reporting period. The assessment for compliance is undertaken in June 2025 and annually thereafter. So the important fact here is actually the assessment date, the June 2025. So since that assessment date is not until subsequent to year end, that liability can be classified as long-term. However, again, the main change you'll see here is the additional disclosure requirements. A company will now be required to put additional disclosure on if they anticipate being able to meet those covenants, and if not, how they plan to resolve them. A second example. During the year ended December 31st, 2024, the company issued convertible notes with a face value of $1 million, which are due 3 years from the date of grant and accrue interest at a rate of 12%. The holder has the option to convert the host liability into the company's own equity instruments at a 20-day weighted average price at any time before maturity. So here the important factor is the holder's rights. Since they have the right to convert at any time, the company does not have the right to defer the liability. Therefore, in this case, it would be classified as current. So, in summary, the amendments are effective January 1st, 2024 and are effective retrospectively. They clarify the criteria for classification of liabilities with covenants as current or non-current. The amendments also require companies provide additional information to stakeholders through additional disclosure requirements. So if any of you foresee this may affect your company or have any additional questions, feel free to reach out to us, your audit team, or myself, and we're here to help you determine how that may impact you guys. So next, I'll turn it off to Catherine, who will be discussing IFRS 18.
Thanks, Carmen. Good afternoon, everyone. Gotta love free entertainment here. All right, my name is Catherine Tai, and I'm an assurance partner at Davidson & Company. I'm very happy to be here to give you a sneak peek into a new and exciting standard, IFRS 18. In April 2024, the IASB has published a new standard, IFRS 18 Presentation and Disclosure in the Financial Statements, which will replace IAS 1, Presentation of Financial Statements, as the primary source of requirements in the IFRS accounting standards for financial statements presentation. The impacts of the new standard are pervasive, and the new standard applies to all entities that prepare and present financial statements using IFRS accounting standards. The new standard applies to all reporting periods beginning on or after January 1, 2027, with mandatory retrospective application. The intent of these changes is to increase comparability, transparency, and usefulness of information that will lead to better information for better decisions. The changes can be grouped into three main buckets. The first one is new required subtotals in the statement of profit or loss, disclosures about management-defined performance measures, and enhanced requirements on grouping of information. The first bucket of changes is the income statement structure. IFRS 18 requires all entities to classify income and expenses into 5 categories based on the main business activities, present a newly defined operating profit and other subtotals in the face of the income statement, and present operating expenses either by function, by nature, or on a mixed basis on the face of the income statement. The changes to the income statement structure are driven by users' concerns and difficulty comparing financial performance because company statement of profit or loss vary in content and in structure. Under IFRS 18, 3 new defined categories are introduced to provide consistent structure of the statement of profit or loss: operating, investing, and financing categories, very much like the cash flow statements. And 2 new required subtotals are introduced to enable analysis. Operating profit, which gives a complete picture of a company's operations, and profit before financing and income tax, which gives a picture of a company's performance before the effects of financing and taxes. Now let's go over the different categories. What is in the operating category? They include all income and expenses from a company's operations derived from an entity's main business activities, and any income and expenses that are not classified in other categories, i.e. the default category. What is in the investing category? Income and expenses from assets that generate a return individually or largely independently of other resources held by an entity, such as rental income and expenses, interest income, and fair value changes on financial assets, such as debt securities, income and expenses from joint ventures, income and expenses from cash and cash equivalents. What is in the financing category? They include all income and expenses from liabilities from transactions that involve only the raising of finance, such as bank loans and reduction in financial liability, and interest expense and effects of changes in interest rates from other liabilities, such as lease liabilities and defined benefit pension liabilities. The inclusion of income and expenses in the different categories is not the same for all entities. For some companies, financing and investing activities are the main business activities, such as banks and investment companies. These companies would include in their operating activities income and expenses that would be included in other companies' investing or financing categories. An entity is required to use judgment to assess its main business activities. Under IFRS 18, foreign exchange differences categorized in the income statement are classified in the same category as the income and expenses from the items that gave rise to them. For example, an entity classifies foreign exchange on cash and cash equivalent denominated in a foreign currency in the investing category and debt issued in a foreign currency in the financing category. If classifying foreign exchange in each category will involve undue cost or effort, they are classified in the operating category. The introduction of management-defined performance measures, or MPMs, disclosure in the financial statements is another significant change brought by IFRS 18. Users express concern that non-GAAP measures are useful, but there is a lack of transparency of how these measures are calculated. The objective of MPM disclosure is to enhance transparency of MPMs and increase users' understanding of how MPMs compare with the measures defined by IFRS accounting standards. IFRS 18 defines MPMs as subtotals of income and expenses that are not required by IFRS accounting standards, included in public communications outside of financial statements, such as management commentary, press releases, or investor presentation, and measures that communicate management's view of a company's performance, financial performance. IFRS 18 introduces requirements to disclose in a single note reconciliation of MPM back to IFRS defined subtotals, explanation of why the MPM is reported, explanation of how the MPM is calculated, and explanation of any changes to the MPM. And this is what a reconciliation might look like. First, you start with operating profit subtotal of $57,000, then adjust for items such as impairment losses, restructuring expenses, gains on disposal of property, plant, and equipment to come up with adjusted operating profit of $65,100. It is important to note that MPMs are disclosed in the note to the financial statements and therefore are subject to audit. As your friendly neighborhood auditors, we will need to assess the completeness of MPMs and obtain from management an understanding of how these are defined and calculated. The third bucket of changes is the requirement to assess aggregation and disaggregation of information. Users express concern that some companies don't provide enough detailed information, and sometimes important information is obscured, say in other items, under the current standard. IFRS introduces enhanced requirements for grouping of information, guidance on whether information should be in the primary financial statements or in the notes, and guidance on disclosures about items labeled as other. A set of primary financial statements made up of statement of financial position, statement of profit or loss, statement presenting comprehensive income, statement of changes in equity, and statement of cash flow. The role of the primary financial statements is to provide structured summaries of a company's assets, liabilities, equity, income, expenses, and cash flows. And the role of the notes to the financial statements is to provide material information necessary to enable users to understand the line items presented in the primary financial statements and to supplement the primary financial statements with additional information to achieve the objective of the financial statements. Applying the principles of grouping information, an entity will use its judgment to aggregate assets and liabilities, equity, income, expenses, and cash flows into items based on shared or similar characteristics. Disaggregate items based on characteristics that are not shared or dissimilar. Aggregate or disaggregate items into line items in the primary financial statements that provide useful structured summaries or disclose material information in the notes, and ensure that aggregation and disaggregation do not obscure any material information. Some examples of characteristics that an entity may consider when grouping items include their function, nature, and measurement basis. Now let's walk through an example. An entity is evaluating the items to present in the operating category of the income statement. This entity decides to present the analysis of the operating expenses on the face of the income statement by function, as it reflects the most useful structured summary of the operating expenses. The entity classifies expenses related to its production activities such as raw materials, direct labor, and depreciation into a line item called cost of sales. The entity also incurred other operating expenses such as human resources, legal, accounting, commission, and marketing costs. The entity may determine that human resources, accounting, and legal share similar characteristics as they relate to administrative activities, while commissions and marketing costs share similar characteristics as they relate to selling activities. The entity then further evaluates if aggregating administrative and selling expenses as one line item called selling and administrative expenses would provide a useful structured summary. The entity concludes that the characteristics of these administrative and selling expenses are sufficiently dissimilar and that further aggregation is not appropriate. Accordingly, the entity presents two separate line items called administrative expenses and selling expenses on the face of the income statement. Lastly, the entity provides additional information in the notes about the nature of the expenses and other material information necessary for users' understanding of the expenses. IFRS 18 requires entities to use meaningful labels and use the label other only when it is unable to find a more informative label. They are consequential amendments to other standards as a result of implementation of IFRS 18, and they include IAS 7, Statement of Cash Flows, IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors, IAS 33, Earnings Per Share, and IAS 34, Interim Financial Statements. In summary, the changes brought by the implementation of IFRS 18 apply to all entities that report under IFRS accounting standards, and as you can see, the impact is pervasive. The changes also require management to apply judgment in determining whether certain expenses will be under the operating, investing, or financing activities based on the main business activities, as well as the aggregation and disaggregation of information. Over the next couple of years, we will continue to provide guidance on this topic. Please stay tuned. Now I'll hand over to Michael McLaren and Stephen Hawkshaw, who will share with you some common issues noted in auditing junior mining companies. Thank you.
Perfect. Thanks very much, Catherine. Thanks and great to see everybody. For those of you who don't know me, my name's Michael McLaren. I'm also one of the assurance partners with the firm. So as alluded to, my commentary will be on, call it an industry spotlight on the junior resource sector. Not so much about how or when you can more easily raise money, but more about when we have more challenging or difficulties or hiccups from an audit perspective. So those two areas I'm going to focus on are with respect to reclamation provisions, otherwise commonly referred to as AROs, and the assessment of impairment indicators in the context of IFRS 6. And then I'll pass it over to Mr. Hawkshaw here to talk about some CAS 315 considerations. So from a reclamation obligation perspective, there are a handful of areas that we see as themes or trends amongst issuers. Some of these will include reclamation obligations that have not been assessed, frankly, at all, or there's inconsistent with other publicly available information. So sometimes then we'll get into the course of an audit and start raising questions around what reclamation, if any, is required, and management at the time has not made an assessment of that work, which could cause further delays in the conduct of the audit, or perhaps is inconsistent with other available information. And really what I'm getting at there is we will look to companies' promotional materials, so perhaps a corporate presentation, MD&A disclosures, the company's own website, perhaps any environmental reports that are available, and say, well, we're looking at the corporate presentation and we can see roads and camps and air runways, a whole number of potential disturbances, yet the company has represented that there's no obligations for future reclamation. So we may question that when we're looking at the provision about why one has been recognized or why one has not. A common argument that we sometimes receive is that any reclamation has been covered under bonding. And while that may be true from a compliance perspective to allow the company to undertake its exploration activities, from an accounting perspective, those are two different matters. So if the company has posted often reclamation bonds with a state agency, that will be accounted for as an asset on its own. Notwithstanding, from a provision perspective, we would also be separately looking at the recognition of a liability for the reclamation work. So in a roundabout way, saying that just because we have a bond posted, that would not qualify you to then not recognize a liability simply because that bond is in place. Inherited obligations. This sometimes can catch issuers off guard on newer acquisitions. We see occasionally with purchased mineral properties from other issuers or individuals. This is more to do with perhaps advanced stage exploration or past producing properties, where issuers may presume that simply all the value, all you've acquired is a mineral property from an accounting perspective. And there's limited assessment as to whether or not there's any obligations for past reclamation work. So that may, in certain cases, depending on the jurisdiction being operated in, cause certain issues around legality. Whose obligation is it? Is it the past operators? Does it follow the land? Does it become your inherited obligation? And I've seen that occur in a few cases where it can be gray sometimes, and it may require some legal interpretation of who is responsible to reclaim that land. And in certain cases, it may not be overly material, in which case, great, we can move on. But if you're acquiring a past producing property with a full tailings pond and the works, there may be a bit more research that goes into that analysis. Obligations are not current, therefore not recorded. Again, we've seen that suggestion come up where a company may not be, they'll acknowledge that a reclamation obligation exists, that we have roads, drill pads, other work to be done and reclaimed at a future point in time, but we're not going to do it right now. It'll be 3 years, 5 years, 10 years down the road, so there's no need to record the liability right now. Again, the provision is a point-in-time assessment. If there is disturbances, whatever those may be, roads, drill pads, etc., it's that point-in-time assessment. So it may be factual that that reclamation will not occur for a number of years, notwithstanding that assessment of the exposure at a point in time still has to be made. Lump sum obligations as audit support. This is one of my favorites. When we get a description of work to be done, again, generally more so on the exploration side, Companies conduct an exploration program, has a number of drill pads, some roads, who knows what. And the reclamation provision is $100,000. But from an audit perspective, really what we're looking for is a more detailed breakdown of how did you come up with that $100,000? So what we're looking for in the first place is to say, okay, what's the scope of work? What is required? If you were to walk away from this project today, what would be the scope to put this back to the way it was? We want to know the costing of the work, and we want some detail to that. So it could be machine hours, man hours, rental costs, consumables that go along with it. What are you going to have to incur to put this back to the way it was? Timing of work, and this is where we start to get into more significant estimates. When is this likely to occur? And if exploration is ongoing, that may be 3, 5, 10 years down the road. So again, there's going to be a question of timing going into that estimate as well. And like most calculations, an inflation and discount rate applicable to that calculation also. And the last point on reclamation provisions that I wanted to bring up is the use of relevant experts, and more so, not so much at the sort of grassroots exploration stage. We see this more so to do with potentially inherited past producing properties where there's more substantive obligations. Think tailings ponds, mill sites, anything a bit more substantive where there's some significant reclamation work to go on. The issuer may not have the expertise in-house to prepare the full costing and scoping for that reclamation and have to outsource to engineers or environmental firms to look at the costing of that. So the reason I bring that up is that if you are inheriting a project that has those past producing properties, it may impact your timing because those firms or those experts may require 4, 6, 8 weeks to prepare their analysis and reports to provide it to us as auditors to review. Moving on to assessment of impairment indicators, and again, this is in the context of IFRS 6. A common pitfall that we commonly see is that there is a lack of planned expenditure or very limited expenditures that have been incurred or planned in the future. So this is an explicit impairment indicator under IFRS 6. Around the lack of planned expenditures, and there may be valid reasons for why that could be. But what we're looking for as auditors is to say, okay, well, why is there a lack of planned expenditures? And say, well, you know, what's our plan going forward? Are we not interested in the property? Are we trying to enter into a joint venture with somebody to fund the exploration? There could be a number of reasons for that, but what we're looking for is an estimate and say, okay, well, what is the company planning to do with this project in the next year, the next 2 years? Are we going to go out and drill it? Are we going to go out and do some sort of other sampling? But for us to get an analysis and say, well, we don't really know what we're going to do, we have no plans, that's going to be problematic for us in assessing those impairment indicators. Non-compliance with option or purchase agreements. You know, we're fully cognizant of the markets and that you know, compliance with agreements is not always easy when you have cash payments due and exploration requirements. But if the company at a point in time is not in compliance with its terms, either under an option basis or a purchase agreement, we're going to be asking the question saying, okay, well, is that in and of itself an indicator of impairment? And that's not to say that it is, but we will be looking for other factors to say, okay, is the company in the process of renegotiation? Can you prove that to us? Have you reached out? Have you emailed the vendor? Is there something to prove that you're actually still trying to move this project forward? Conversion to care and maintenance. Again, this is more in the context, more so from an operating perspective, being placed in care and maintenance. Generally, that is going to be a pretty clear indicator that you're going to be assessing for the recoverable amount of that project. This could also kick in sometimes if you're looking at perhaps a advanced stage exploration project, and out of the blue the company says we're going to pump the brakes and then, you know, really not spend anything on this. For us, we're probably going to look at that and say, hey, you know, you were really going after this property, you know, pretty aggressively, and now you're not. So what's the reason for that? And again, there could be valid reasons, but we're going to ask that question as to The last point I wanted to bring up on the impairment indicator assessment is with respect to assessment of dropping or reducing land size. So we understand that it's quite common to the industry to drop a number of claims depending where you're operating. It could be peripheral land that's not overly relevant to the overall project, but that should be considered and analyzed to say, well, if we're dropping 50% of our land size, is that in and of itself an indicator to assess the recoverable amount of a project? So again, just a few different factors that when we're going through the analysis from management in terms of determining if there are indicators of impairment to then trigger the requirement to assess the recoverable amount. These are some of the pitfalls that we commonly see that are not always thoroughly addressed, and if not, you can probably expect some further questioning from us. So with that, I will hand it over to Mr. Hawkshaw to talk about some CAS 315 consideration.
Thanks, Mike. So my name is Stephen Hawkshaw. I've been an audit partner with Davidson for just under 6 years. And I'm going to touch on CAS 315 with respect to the junior mining cycle. It's obviously relevant to all industries, all companies, and it can get quite significant and intense in other industries. But for now, for purposes of extractive industries, largely looking at E&E and impairment, I want to segue into the conversation by just highlighting a couple things Mike pointed out. So you might have heard him say a couple times, we're going to be asking additional questions on this, or maybe a memo doesn't thoroughly address this issue, so we're going to be following up on this. And one of the things that CAS 315 really does is it sort of puts us in a position. This is opinion of Stephen Hawkshaw, not of Davidson and Company. But it seems like the regulators, the lawmakers, are sort of pushing down assessment of corporate governance to your auditor. We already had a requirement to look at and gain an understanding of your controls, and so now the standards makers are kind of wanting us to effectively audit your corporate governance to a certain degree, right? So one of the things that CAS 315 can do to help you as our clients is if you put in the appropriate systems and processes and document those, a lot of the pitfalls that Mike went through, you might have already addressed before it came to us. You know, if you're looking at impairment and you have dropped land claims, or if you're looking at an ARO and you believe you have no ARO, so your memo or your representation to us says, no, there is no ARO. If we find stuff on the website saying, you got a big road here, you got an airstrip, we're going to follow up on that. Then that back and forth obviously costs time and money. And as far as the extractive industries go, we know that you want to put that money in the ground. You don't want to be paying it on your audit bill, right? So one of the ways CAS 315 can help us both is that if you're putting in processes, and it doesn't have to be ornate, it doesn't have to be very costly to you as a company, but it's simply documenting your discussions. I know when the board gets together and when the AC gets together, you spend a lot of time talking about your projects. You know, outside of compensation, it's probably the majority of your discussions during these meetings, right? But sometimes the minutes will just say discuss properties, or sometimes your memos might be a little bit light on this discussion. And what I would encourage, what CAS 315 encourages, is if you have these checks and balances internally, you're sort of preparing for the audit well in advance. Quarterly or annually, if you have individuals, maybe the CFO or maybe the AC chair or someone asking questions, okay, I agree there's no ARO, but what about that? But what about that? And then you document those discussions, be it in your minutes or your memos or elsewhere. You're preparing a better product for us from the get-go, so that when we look at it, not only can we say that, yeah, they're following the standards, their own processes and controls, so we have no issues, deficiencies, or weaknesses, as the specific terms are, with respect to CAS 315. So not only are we reporting to the audit committee that your processes are operating as intended, but also it might very much reduce back and forth audit time around significant estimate and judgments areas, because you've effectively done that work already. before it's come to us at sort of, your own time. Appreciate that, but better your time than ours, I would think most of you feel. So definitely recommend looking at getting together with your audit committee, getting together with management, and looking at when you assess impairment in ARO, be it on a quarterly or annual basis, and adequately documenting. I know you're already talking about these things, but documenting those discussions so that when the memo comes to us or when you represent there's no ARO or no impairment, a lot of that groundwork is already laid down. A Canadian auditing standard about audit documentation specifically says that not only do we look at evidence that corroborates your opinion, but also we're required to look at stuff that contradicts your opinion. So if you're going out of your way to point out contradictory evidence to us from the beginning, but are able to adequately explain it or minimize it, that is already taking away a lot of the things we need to do so we don't waste time researching those issues, bothering you with lots of back and forth. So I highly recommend that, especially for those of you that may be sort of with a management services company or a fractional CFO type stuff. I can't speak for the people in this room, but I have heard from my clients in the past that sometimes the GOs are out there, the CEOs out there, and they're doing a lot of work, they're making decisions, and that information is a little late to you as CFO or as a management group, right? And so maybe one of the burdens you could take upon yourself is to, okay, it's quarterly time, it's annual time, how are we doing on these properties? Maybe where your auditor at? Well, I noticed we spent a lot of money on a drill program. Has that been cleaned up? And as you gain that information for preparing your memo, it's organized over the course of the year and possibly quite ready before the audit even starts. So that was the primary. I didn't even switch slides. I apologize for that. Right. So that's what I'm referring to, evidencing management and board judgments. We do need to see evidence of it. We agree what you're saying. Our mantra is trust but verify. So by implementing these processes in advance, you're putting us in a position where the verification process is a lot easier for us. Same with formal documented assessments of significant risk areas. CAS 315 really wants us to focus on significant risk areas. Obviously, as our clients, you might not know what we consider our significant risk area, but if you are in the extractive industries, rest assured impairment and AROs will be part of it. And then, of course, if other significant transactions, a business combination or a significant debt instrument with maybe complex terms, just apply the same approach with impairment ARO as to any of these other items, and you'll find yourself prepared sufficiently in advance for the audit. And then finally, of course, there's a benefit to yourselves. Internal risk assessment process. You're going to be going through this process with your audit committee, with your management, and it might bring up questions that perhaps individuals hadn't thought of before. And it may help you understand where your risks are, what your issues are. We've seen instances where claims were accidentally dropped, right? Well, that's obviously a potential impairment indicator. Why are we discovering this at audit time? You would think that management and the AC would have a conscious concern about this, where you'd be discussing this regularly. So by implementing a process, documenting how this process works, you might find yourselves quite often ahead of the game as far as your own internal risk assessment. So that's all I want to talk about. CAS 315 is a pretty big standard, but keeping it isolated to the issues that Mike went through and some suggestions on making your life easier and hopefully your audit bill more cost effective. So that's all I want to say about that. I will now pass it off to Reshma and Elena. Thank you.
Thank you, Stephen. Good afternoon, everyone. How are we doing? Yeah, good entertainment in the back? My name is Reshma Mahes. I'm an audit partner at the firm, and I realize that it's Elena and I keeping you from those refreshments and drinks right now. So over the next 10-15 minutes, Elena and I will spend some time going through some changes in the audit regulatory landscape. And you may ask, why should you care? I would admit this is a recycled slide if you saw this presentation last year. Same slide, slide number 1. But I thought it was still relevant. Relevant because it really tries to highlight or demonstrate the accountability framework. What does that mean? Well, the accountability framework over who's responsible or who are the users of financial statements. Each spoke in that wheel. I know it's a weird wheel, but each stakeholder in that wheel is pivotal in maintaining audit quality, from management, who are preparers of financial information, to those charged with governance, who actually oversees the audit, not so much management, and then of course the regulators, who oversees us as the auditors, to ensure that we're complying with the relevant standards. So why should you care? Well, in recent years, you may be familiar with the regulatory bodies, being the Canadian Public Accountability Board and the PCAOB, being the Public Company Accounting Oversight Board. They've implemented changes. They changed the way they interact with us and how they regulate audit firms, which in some cases has a direct impact to clients. Since 2021, we've seen CPAB. You may be familiar, a bit more familiar with CPAB. CPAB has introduced increased disclosures. More recently, you may have seen more disclosures around inspections of firms and enforcement actions. That was a deliberate change by CPAB over enhancing transparency over their regulatory assessments. That's a lot of words to say. They wanted the public to know what's happening at audit firms and the regulatory mishaps, if you want to call it, that's been experienced. Now there's phase 2 to CPAB's changes, which will actually impact directly audit committees. Currently under CPAB's protocol, there's a voluntary framework, and I believe Davidson is part of that voluntary framework, where we're required to provide to the audit committee a copy of that findings report. So that findings report is a result or a snapshot of an inspection they would have performed on one of the audits. And really what that's requiring now is to present that to audit committees. Before, as part of the voluntary framework, firms could opt to do this. Now, this change is requiring that that's done across all audit firms. Now, for firms like Davidson, like us, it's less of a consequential impact because we're already doing this. But to audit committees, what it's meant to do, it's really spark that dialogue around audit quality and having that discussion with your auditors around what's really happening in the audit environment. Now, back to why should companies care? Well, what we're finding with these changes is it's actually causing a ripple in the market right now, where certain firms have been censored, which is causing clients to look for other auditors, and the obvious delays and disruptions in the business trying to find an auditor, onboard an auditor, which is increasing costs, causing MCTOs or CTOs. So from a direct impact, it's impacting companies quite significantly in the marketplace. For those who are less familiar with our neighbors in the US, the PCAOB, so again, as David said, we are governed or overseen rather by the PCAOB as well because we do a number of US filers. The PCAOB already has certain disclosure protocols similar to what CPAB is introducing currently. So their standard changes actually is less infrastructure and it's more around key standards or changes to how we audit or how accounting works. In around March 2024, PCAOB came out with a quality control standard, which is meant to replace the existing standard. And this standard, really what it's doing, it's forcing audit firms to have controls in place and processes in place over key functional areas that's supporting audit quality, from governance straight through to monitoring and engagement performance. Now, if you remember back in 2021 or 2022, Canadian firms already had to implement this standard called CSQM1, which is a Canadian standard on quality management. This standard that the PCAOB has introduced is actually quite similar to CSQM1, but there are some incremental impacts around processes and controls that may affect clients as well. Another key change that's been introduced by the PCAOB is actually an amendment to two key standards, the audit evidence standard. So if you think of it, that's when we come to you and you say, hey, I need bank statements or I need invoices. And another significant change is around the risk assessment standard. That risk assessment standard for us is telling us to ask you, hey, I need 5 bank statements versus 3. The changes in these standards is really coming because of the changes in industries and emerging risk caused from the use of artificial intelligence or automated tools. So again, why should you care? Well, unfortunately, we're going to see our audit procedures evolve. And it's going to evolve to address risk in these emerging, not just tools, but in how we audit. So these standards are trying to address that. And unfortunately, it's going to change in some cases timing and maybe cost to the audit. This is a good segue now into Elena's section, who's going to speak a bit more about some of these tools and AI.
Thank you, Reshma. Good afternoon. My name is Elena Allen, and I'm an audit principal at Davidson, focused on internal controls. So to wrap up our presentation today, we wanted to go over maybe some key considerations for audit committees as AI becomes more commonly used, especially in financial reporting functions and also on the audit side. We have kind of 5 key questions here that I want to break down. The first one revolves around just establishing how AI and other advanced technologies are being integrated into the company's financial reporting and accounting process. So generally speaking, it's going to be really important for the role of AI, if it's going to be used, to be very intentional and well-defined. There's a myriad of risks at play here, and in order to appropriately mitigate those, there needs to be kind of clear use cases and boundaries around these technologies to begin with. From there, we want to think about some of the key risks that could come from using these technologies in areas such as cybersecurity, privacy, and financial reporting. The risks span many domains. It's going to be very important to have a clear understanding of which ones are being implicated and how we're going to address that. And from the perspective of the audit committee, the key consideration there is going to be whether you have confidence in management's ability to not only identify these risks as they arise, but to adaptively mitigate them. So I have a couple examples here. In the realm of cybersecurity, for instance, if AI applications are to be used, it's really important to ensure that the application you're using only has access to the data you want it to have access to. One example here is, OpenAI, which is the developer of ChatGPT, earlier this year previewed an app for, I think it was like the Mac operating system, that would allow the app, when in use, to have access to everything that is open on a user's desktop, not just what's being directly inputted. So developments like these, they're meant to facilitate ease of use, but obviously you can also see that there's some risk there in terms of potentially allowing access to what could be proprietary or confidential information. Like essentially something like that would allow an application to bypass your firewall or other cybersecurity tools that you use to keep your data safe. Related to that, another good one to think about is your privacy. A lot of these AI applications, they are trained using inputs that are provided by users. So it's kind of an iterative training process. And a lot of the privacy policies on them will tell you that, personal information is placed into these apps. It could be regurgitated out later by the app. So again, from the perspective of a business, it's going to be really important to ensure that stuff you do not want shared outside of your company is not inputted into these apps to begin with. And another consideration is really ensuring, if you choose to involve AI or advanced technologies in your financial reporting or process, or it's being used on the audit side, that the information that's coming out of it is complete and accurate. Again, as I mentioned, these apps are generally trained using an iterative approach. So if the outputs of these applications are really only good as the inputs going in, which means that you can run into situations where the outputs are not necessarily accurate. And so it's important that there is a validation process over any outputs that are coming out before any reliance is placed. So kind of further to this and getting into the internal controls sphere, it's going to be important for those charged with governance and management to consider what kind of controls they're going to put over validation of results that's coming out of applications like this. Another important consideration beyond accuracy, a little bit beyond accuracy, is bias. A lot of AI applications actually do have biases. It's disclosed kind of in their manuals, again, as a result of how the apps are trained. So again, not that they shouldn't be used, but it's something that those who are using the outputs from these applications, they need to be on the lookout for those biases and aware that that could be something that's coming up prior to using any of the information that comes out. Kind of the last question here from a governance perspective is just considering the long-term implications of these technologies for your industry and how you're going to stay ahead of them. This is going to vary by industry, but at the governance level, it's going to be important to stay ahead. and be strategic to ensure that the company is keeping up at an appropriate pace and relative to the competition. Last slide. From a controls perspective, there's just a few things to consider, just getting a little bit more into it. So tying back to some of the points I made on the prior slide, a key consideration around data protection is going to be access controls and privilege management. So an idea is to consider, role-based access. If that's not something that's already been implemented in your organization, role-based access basically means that system permissions and access to data is assigned based on the role of the individual in question, and that individuals only have access to the minimum amount of data required to perform their jobs. Again, this should help mitigate the risk that information you don't want going out into kind of a massive AI training database, it's kept confidential. Another important consideration around this is going to be encryption. Again, if you have confidential information that you just don't necessarily want going into these types of applications, data encryption is going to be a key tool that you can use to ensure that data stays safe and away from unauthorized users and any potential mishaps that could happen with it. From a governance perspective, cybersecurity training remains really important, as does the enforcement of password hygiene and protocols, and just making sure that employees are on the lookout for phishing attempts and they know how to handle those. And then, as I iterated before, these models or AI applications, they're trained often on data that's being inputted, and the outputs are only as good as the inputs. So if you are going to make use of this type of technology and the outputs, it's important to make sure that the data that is being provided to it, aside from not being confidential or proprietary in any way, is complete and accurate in order for your results to have the best chance of being complete and accurate. And I would say the last point of consideration, again, is just having and implementing controls over validation of any information that comes out of these applications that you intend to use. Just again, how they're trained, the information is not always accurate, so you're going to want to demonstrate that you have controls over accuracy and that it's been vouched against the relevant standards, be that financial reporting standards or accounting standards, to make sure that anything that's being used is actually in line with the standards it needs to be in line with. So that's all I've got. With that, I'm going to hand it back to Erez for some closing remarks.
Okay, well, thanks everybody. That was really good, informing, and efficient. So we'll do a bit of a Q&A session, and I've got a couple questions from most people here. And if it's okay with you, when I call your name, could you come up here and stand next to me? And then I'll have a little bit of a dialogue with you, just to make sure the sound's okay. And then hopefully I'll try not to ask you anything too tough. But the one thing as I'm listening to all the speakers, there's one common theme here, it seems to me, and that is increased disclosures. Even at our firm, Reshma touched on it, but a long time ago when the regulatory bodies to inspect auditors got formed, the whole focus of the inspection was files. So you would pick a reporting issuer, and then we would just get into it, and that was the main focus of inspection. And what's been happening over the last couple of years is the shift is more towards firm controls. And so what's been happening, and just like you Stephen Hawkshaw was talking about how, in your director's minutes, instead of just saying, we talked about the property, maybe you could add a few more comments on there. Like, we talked about planned expenditures, and currently we're thinking of spending, $500,000 over the next 12 months, and, we're going to raise finance to do so. So what he's saying there is, the more you document in your internal records about what's going on within the company, the more you're showing us, the auditor, that you're kind of following your processes. So it's the same thing for us, the accounting firms. We used to also sit, 15 years ago as a partner group, and we talk about various stuff, right? And then the documentation at the end of the day was a one-page, half-a-page thing saying we met and we discussed. And that's what we see a lot in directors' minutes too, right? We reviewed the financial statements and then we approved them. So what we're saying here is that this increase in disclosure, and you heard about, which I thought was really interesting, the MP, I wrote it down some here. What was it, Catherine? MPM, right? About how that's going to go in the financial statements. And I'm starting to think, oh boy, now you're adding a lot of stuff into the notes that are not even IFRS, right? Let alone how we're going to get around it. So, whether we like it or not, disclosures increasing and transparency increase. And then you'd say to yourself, I like that Warren Buffett line that he used to say, 50 years ago, I used to read financial statements and they're about 10 pages long and I understood them. Now they're about 100 pages long and I don't really understand them. So what's the real benefit of all this? And I can tell you that we're a bit concerned about that too, because now you've got information overload, and before you know it, you're spending most of your day just looking for minutes of reporting issues rather than really trying to understand if they spent the money in the correct place. But then with the use of technology, like we use this tool called Data Snipper, right? And it just matches numbers from different documents, and a lot of the regulators use these different AI tools now to kind of match numbers and words for different search functions. So even though the paper is going to increase, technology will kind of minimize the amount of work a human being has to look through. Like there's actually, in a lot of the reporting issuers see now that we spend often a lot of time vouching your expenses, right? Like your payroll and everything you spent, in a foreign country. And now software is being developed where you just enter all the invoices, all the bank statements, all the contracts into one dump, and in theory, the AI is going to kind of match it all up. So, at the end of the day, it's just going to be more, but hopefully technology would kind of offset the amount of the human work that needs to be done. So, in no particular order, Anita, could I ask you to come up here and ask you a couple, hopefully not so tough questions from the audience? And by the way, if somebody doesn't know the answer, we'll look it up and we'll refer to it. We have a couple more here too. Okay, I'll get to that one in a second. Okay, well, I'll read that one if that's okay. I'm seeing you. Hi, Anita. Is ESG disclosure a dead issue now?
Thank you for the question. I would say it's not dead, and I know the Canadian Securities Administrators, we've been silent, but I think the last public news release we've issued was saying that we are monitoring developments at the Canadian Sustainability Standards Board. So their exposure draft or their comment period closed, and they've recently, I think fairly recently, published a comment letter. So we're reviewing that, and we've always said that we're anticipate creating disclosure standards based on the CSSB standards and modified for the Canadian market as appropriate. So that's why we're really looking to see the results of the comment period, the comments received by the board on various topics. No surprise, some of the more contentious areas relate to Scope 3 emissions disclosure, scenario analysis, timing of reporting. So these are areas we're looking at. In addition, there are various other comments that we've heard from market participants, including safe harbor requirements relating to certain climate-related disclosure. So these are kind of the areas we're still working on. Please don't think it is dead. And just a reminder that if there are climate-related or ESG risks that are material to your company now, they already require disclosure under other securities law requirements anyway. So.
Okay, great. Yeah, and from what we're hearing, Anita, on that is that a lot of companies have spent sort of money on those programs, have slowed it down with the economy a bit,
yes,
and which is maybe counterproductive. But it seems like there will be another genesis once the markets pick up, and reporting issuers are going to start devoting some budgets towards this as well. So it's a sign of the times a bit, maybe.
I think so, and I think that's something we've heard from various sources, that until we mandate something, I think it's a little bit of chicken and egg. Companies are, well, we're not ready, and part of us assessing when we put something in place might be, how's voluntary disclosure looking like? Are our marketplace ready? So I think it's a little bit exacerbated with our venture market in BC especially, and it's not clear that all users of all issuers require climate-related disclosure. So we're trying to be very mindful in terms of how we introduce requirements to our marketplace.
Okay, thanks. Maybe I could bug you one more question
Sure.
before I let you go. There's actually two more questions for you. I'll let you choose which one but the one question that keeps popping up, and you talked about thinly traded stocks,
yes,
with respect to business combinations. And the question is, with these stocks, do you always use market price, even if it's thinly traded, and may yield a massive goodwill that's difficult to explain?
do we always
use market price of the stock,
think-
even if it's thinly traded?
I think that's always the starting point, because it's almost a definition in the standard in terms of that's the exchange amount. I think some of where we get, it's these anomalies that they stand out in the financial statements, and where it's not explained well, I think that's where we raise questions. I think it is it's a starting point, and if you could explain at least the number of shares, even if the pricing, and we know there's a timing difference. You might have entered into an agreement, by the time it closes, things go a little differently than how I anticipate. So I think it's definitely a starting point, but it does result in anomalies where we raise more questions.
Okay, thanks for that. And the last question, the last one, so you talked about continuous disclosures,
Yeah.
and it talked about how if you're doing an exempt prospectus, then it might trigger it. Does the BCSC do random? Does it have a mandate where it has to review issuers after a certain amount of time?
No, well, I don't, so I won't misspeak, and I'm trying not to misspeak, and I haven't been in the corporate disclosure world for a while there, but I think we obviously review all prospectus filings, and we try to get a certain market cap coverage in our reviews, but I think we're really using a risk-based model or a complaints-driven as well. For the exempt offerings, I think the life offering exemption that I mentioned is really focused on where the policy rationale for why the exemption exists is based on your continuous disclosure record. So I think that's where the tie-in to your CD record gets reviewed, and it's not all it's a high-level scan, and if warranted, more work is required. Like, we are very mindful of the requirements aren't meant to be the same as for CD.
Okay, great. Thanks for bearing with me, Anita. Catherine, could I call you up here next? I was going to say the hot seat, but we're not going to sit down. We're going to stand up. So just, one really, interesting question about the MPM, right? So MPM is Manager Performance Measurement. So for those of you who have seen this before, we've seen a lot of issuers in your MD&A start with net income per IFRS, and then you make a lot of adjustments, and all of a sudden you've got a huge income from a loss, right? Congratulations, right? And adjusted EBITDA are terms that we've seen, or non-GAAP adjusted EBITDA, all kinds of creative numbers. So from what I heard from your presentation is that this creativity is not going to go into the notes of the financial statements, and it's going to need to reconcile back to IFRS. That's about right?
That is correct.
So I guess the question is, for companies that we've seen, and if we don't know this, because it's a couple years away, right, this new standard?
2027 is the effective date, but there's retrospective application. So you have to go back, when you present your 2027 financial statements, you have to go back and restate your 2026 numbers.
And at this stage, do we know whether non-financial stuff would be included? Like, for example, number of subscribers for something from year to year. Is that going to be in there too?
Actually, the MPMs only relate to income statement items.
Okay.
So, revenue per subscriber, that is not really income statement, because your subscriber, your denominator, is not an income statement. So items such as adjusted operating profit is a good one. Okay,
so does that mean the adjustments need to tie in to somewhere in the financial statements?
Yes.
Okay.
Yes.
Okay.
Say you start with operating profit, and then you make the adjustments, things like impairment losses, restructuring expenses, and you come up to the adjusted operating profit.
Okay, and then the big comment I heard under the new standards is that we're going to have to classify everything into only 5 categories. Is that right? Just 5 income statement categories?
The main ones are operating, investing, financing, and then they have 2 other buckets, which is the subtotals are operating profit, and then profit before financing and income taxes.
Okay. So those are, for those of you, thanks, Catherine. We're good. For those of you who have been keeping up with IFRS, there hasn't been that many big changes in the last couple of years, but these ones appear to me substantial. We've got a couple of years. And then, Carmen, just a quick question for you as well, if you don't mind coming up here and showing yourself again. In your presentation was a lot to do with, classification of liabilities, right? I mean, correct. Is it fair to say that overall, there's going to be just more current liabilities than long-term as a result of this? Is that where it's going?
Yeah, I would say so. Now the new standard, as I mentioned, defines instead of defining what a current liability is, it defines only when you're allowed to classify something as a non-current liability. So yes, that's likely correct. And then in addition to that, you will also have to have the additional disclosure. And I think that's where most people would be caught with if they're going to have potential issues of meeting a covenant in the future, they're going to have to add disclosure on what they foresee they're going to do to try and meet that covenant.
Okay, so this could potentially push lots of liabilities into current, which could affect ratios,
Working
going concern,
capital.
working capital, et cetera, as well. Okay, no, that's the one question for you. Thanks, Carmen. All right. And then, so Mike, if I could, Mike McClure, come on up here, Mike. Because everybody gets to see some of our superstar partners here as well. A great young group of people who are much smarter than we were. Mike, so you talked about the junior resource industry and impairment indicators. And then one of the things you said was if you have a lack of planned expenditures, that could be a sign of impairment. So a lot of companies have planned expenditures for the property, but they're having a difficult time raising money to do that. So when we look at that, and if companies come to us and say, well, here's your planned expenditures, here's our plan, but we just don't have the financing currently, is that going to be an issue for us?
I'll give the auditors their favorite answer is that it depends. Generally, if it's 1 year, maybe 2, perhaps not. The company has intent, wants to move forward with the project, we can understand that. Really what we're going to be probably most concerned with is that it's a prolonged lack of expenditure. So year after year, the company may be meeting its minimum holding costs, but there's really no substantive expenditure. And that's the word in the standard, is that it has to be substantive. So holding costs, again, that's just going to be keeping the property in good standing. After a period of time, it's to be judgmental based on how long that is, but obviously we are cognizant that raising money can be difficult at times, but what we're going to be looking out for is that prolonged lack of expenditure.
Yeah, and how long is that generally? Is there a timeline for that, or is that also judgmental?
It's going to be judgmental. There is the old Canadian GAAP rules around 3 years. Some people still kind of use that as a rule of thumb. That's not an IFRS measure, but it is going to be judgmental. And it could be 1 year depending on facts and circumstances. It could be longer, but it's going to depend on each case.
Okay, great. Okay, that's good for you, Mike. Thanks, Mike. Steven, you want to come up here and say a quick hello with us? Is that okay? Come on up here. Get a little stretch of your legs. Yeah, I do. I do. So, you talked a lot about documenting process, right? And you talked about CAS 315, and really it's documentation, right, about companies. So when we're giving guidance to reporting issues about documenting their process regarding, impairment of a property, what are we asking them to do for all areas of the financial statements, for just the risky areas? Like, how do they know what we expect of them to do in certain areas of finance in terms of documenting their processes, if that's clear enough?
Yeah, that's an excellent question. I sort of alluded to, we were required to go through this process on our significant risk areas, and you might not know what those are. In the junior mining space, that would typically be impairment and ARO. Those are the big ones. But also, it's what do you consider to be a risk area? Think of it that way. Where is an area where your processes might not catch a misstatement, or is there an area where you've had misstatements in the past, or getting pushback from prior auditors, us in the past? Are those areas that are subject to significant estimation or judgment? As a starting point, maybe look at your financials and what are you saying is a significant estimate or judgment. That might be a good starting point as far as areas that we're going to look at it. And like I said, I don't disagree. You're having these conversations all the time. This is, for the most part, all the board does, right? It's evidencing the documentation of those discussions. I won't speak to whether you want to put this in your minutes, maybe talk to your corporate securities or whatever. I don't know if there's any ramifications there. But at the very least, you could take those discussions and sort of put it into a sort of your own internal memo to file kind of idea. And then when you have your auditors asking, you say, well, here's the assessment we did in Q2, or here's the assessment we did at year end. And that'll significantly save us time if you've made some of these considerations at the beginning.
Okay, great. Okay, thanks, Stephen. And I got a question here from the audience too. I don't know, maybe Elena, I don't know if you could help me out. I'll start, but do you want to come up here, Elena, as well? And then Reshma, I'll get to you as well. We just have a few more minutes left. So the question is how are auditors or Davidson using AI in their audit processes? So I could start, maybe you could think about that for a second, but we really, we use a number, like in the old days, what we used to do is get your financial statements, right? And then we'd have like a little calculator in front of us and, we'd add it all up. And then we put those little signs at the bottom, like footed or cross-footed, and there's a number of accountants in the room here that are giving me a bit of a look so that you understand what I'm saying. And then you'd submit the financial statement to your partner or your manager, and you had the little cross-foot sign there, and that probably meant that you added it up and you didn't find any adding errors. And then we sort of did the same thing. And now we just throw that into a software that just adds it all up for us. Right, that's a simple AI tool. Have you seen anything else there that we do or that you've seen other firms do at this stage? And I got a couple more thoughts too.
Actually, no. And the reason being is confidentiality.
Okay.
AI just it isn't at a place where we can secure your confidential information in using it. So from what I've seen, like what you described, that's the extent of it so far.
And most firms, and we talk to the big firms, small firms, right? Other than Googling Chat GPT and asking how to audit this thing, we really don't find that to be that effective. Because the one thing we notice about audit is that it requires still judgment, and a computer not quite there yet on judgment calls. Because really, a lot of what we do is deciding how much work we believe is necessary to sign off on a financial statement numbers, and we follow programs and we follow guidelines, but it's quite a bit of judgment. I guess the only other AI tools that really I've seen sort of effective is that example we provided about vouching expenses. So there's software out there right now where you just dump all your bank statements, dump all your invoices and all your contracts, but all it really does, it just matches numbers and words. So if the numbers match, then you can kind of say, I vouch that, because I tied that to the invoice or the bank statement and the contract. But that comes with a lot of flaws too, because numbers, they may match, but they don't always mean that they're correct. Thanks for that, Elena.
Yeah, no problem. I would add one thing.
Please do.
Further to that, I have seen some companies develop proprietary AI technology where they can control the flow of information. So I've seen some applications, to your point, for really specific types of audit testing. But as it pertains to the widely available AI platforms like the Chat GPTs, that's where it's a no.
I always find people just use the term loosely, right?
Yeah.
But when I actually start to define what it actually means or what people do, people struggle with that. They just like to use it. But thanks, Lena. Reshma, you want to come up here for a bit of a regulatory? So one of the things that you talked about was, this enhanced disclosure that PCOB's been doing for a long time, and now CPAB have followed suit too. And it's naming firms, will it get to a point where the reporting issuers are going to be named too if there's an audit flaw, or will it? Where is it heading, and why is this happening?
Yeah, good question. I could say I don't know, but what I would say is that the goalpost continues to change, unfortunately. With the Canadian regulatory body, it's pretty new, right? They do model, and I'm just talking from experience loosely, they do model it, or their model behind PCOB's model. So these disclosures that's coming in, it's really to enhance transparency about the inspection findings. Because if you recall, a couple years ago, there was this massive, exodus in the marketplace where a lot of companies were looking for auditors, and it was really being triggered by censure, right? So CPAB had issued a bunch of inspection findings, firms weren't allowed to take on clients. So it really created that ripple effect. So with reporting issuers being named, I highly doubt it, to be honest, because they don't, the regulatory bodies don't mandate clients, they mandate audit firms. Right. So they can name audit firms. What it's triggering is the audit committee communications, where audit committees now would be required to know if a file is being inspected and the results of that.
Right, okay, okay, great, thanks Reshma.
No worries.
And then, more about to come in our January session, because CPAP participates in that as well as the BCSC and TSX, so, we can kind of go back to that and ask some questions too. So just the last couple of housekeeping items. Again, after this, you usually get an email that'll say you attended this PD with a bit of a feedback form. We'd really appreciate if you fill that out. It kind of helps us out to understand future topics as well. For those of you who will watch it remotely next week, that email should come to you as well. And then I often get asked the question, what if I didn't come, and what if I wasn't able to log in online? Can I still get the credit? So we make these videos available on our website for quite a while after this, so you can still get your PD credits. You'd have to claim it as unverifiable because you weren't here. We trust that you watched it, but to verify it, so just watch out for that. And if you got any questions on that, feel free to let us know. I'd like to also thank our admin team in the background, Bahar and Sonia, our camera and our sound that had to deal with a couple of things here today. There's quite a bit of work that goes in the background here to make this happen. Thanks a lot for everybody to come. A real thank for our speakers, Anita, specifically that came from the BCSC, Carmen and Catherine, Michael and Stephen, Reshma and Elena for spending their valuable time coming up here and sort of disseminating some of the information. I think that covers it, so please stick around for an hour or so, hang out with us for some refreshments. Nice to see everybody. Hope everybody had a nice long Thanksgiving weekend and has a nice start into the fall, into the holidays, and we're very excited about the future, and thanks a lot for supporting our firm. Have a good rest of your day. Thanks.
What makes us the go-to auditor for public companies is we take a client-centric approach.
We perform a variety of audit-related services.
Of course, we do public company audits, interim reviews, initial public offerings, secondary offerings, and we do internal controls audits as well.
We perform audits across many different industries. Some of them are renewable energy and mining, crypto, cannabis, technology, and manufacturing.
Being a part of Nexia allows us to have global reach, having affiliates in almost every country in the world.
Being a member of Nexia allows us to tap into local expertise and deliver cost-effective audits and bring value to our clients.
We are experts in acquisition transactions as well as all financings for companies going public.
So at the firm here, we're agnostic to the industry. We're market driven. When the market chooses a new industry, we build up our expertise to learn how to do it.
Having the same audit team allows both us as auditors and our clients to realize efficiencies, utilizing accumulated knowledge year over year, so that we can help you anticipate and solve your problems.
What sets us apart is our audit team is always available. You can pick up the phone and get a hold of us.
But I would say the biggest one is the people. Our name in the market and even internally, we are the people as you see. We are represented well by our personalities and our agility. I think that's why people come to us.
In the context of audit engagements, our agility ensures that we swiftly adapt to the evolving needs of our clients. Our service exemplifies integrity by consistently delivering honest and transparent solutions.